afternoon and welcome to the Real Men of Real Estate here on KCAA Radio. You can find us on your dial at 106.5 FM, 1050 AM, or right here at kcaaradio.com. Today I'm joined by Gabe Candea, who's going to be talking to us about 1031 exchanges and Delaware Statutory Trusts. So if you're not familiar, listen up. This is going to be the next hour of the best information you can get on the topic. So welcome, Gabe.
Welcome. Yeah, thanks a lot, Dan. I appreciate it. This is
You're
exciting.
welcome. Yeah, I really appreciate you being here. This is going to be tons of fun. So, to get things kind of going, why don't you just tell us a little bit about yourself? Who are you? What do you do?
Sure, absolutely. Yeah, my name is Gabe Candea. I'm here in San Diego. I'll take you way back before I was even born. My grandparents came to this country from communist Romania in the 70s.
Oh, wow.
And, they literally had their home taken away because you're not allowed to own private property. So when they came to this country, they really understood the power of that. And they went ahead and just passed the hat around and with friends and family and bought a mixed-use building in Chicago, Illinois. And I grew up in that building pretty much.
That's incredible. So
yeah,
real estate has really died in the
it
wool
really
for
is.
you. Wow.
Yeah, it's the dinner table talk and all that. It's in my blood. And so grew up in that business. Everything from my dad was an electrical contractor. My uncle was in management. My cousins are in development. So the whole thing was just purebred real estate guy.
Wow.
Fast forward, in 2010, I moved to San Diego and get into property management out here, and really learn the lay of the land, how to manage rental properties and run the whole show in terms of leasing, management, orchestration of maintenance, accounting, etc. Quickly moved on from
Was
there.
that your own portfolio that you're managing?
No, I worked for a county-wide property management company. We had
Okay.
about 2,000 units all over the country, all over the county, and we had and basically I was doing business development for them, and I managed about 100 units myself. So
Got it. Okay.
great experience for learning how to run a rental property, which was
Absolutely.
very cool. So that kind of fundamental education really helped me out with my next phase of my career, which was multifamily sales. And so I did that for about 10 years. And I chose a neighborhood. We call it a farm, right? The neighborhood you want to work in. And it was probably the worst neighborhood you want to be in if you're going to be a new guy on the road doing this show.
Where was it, if you don't mind my asking?
It was multifamily real estate in the coastal neighborhoods of San Diego. We're talking about La Jolla, Pacific Beach, Ocean Beach, Point Loma.
That has got to be a vicious market.
It was tough because, most people don't want to sell. And so I had to figure that out the hard way and beat my head against the wall a bunch of times. And what I came to realize, and this is really what kind of led me what I'm doing now, most of my clients, price was not a primary interest of theirs. Really, tax mitigation was one of the biggest questions they would have. They'd say, Gabe, listen, I get it. You're telling me my property is worth more than it was before. That's great. I'd love to sell it, but I got two problems. One, if I sold it, I don't want to pay the taxes. Two, what would I reinvest my money into? Here I am. I've got a great asset, and I'm going to need something better if you're going to get me to sell it. So I did everything under the sun that you could think of creatively. I did installment sales. I did master leases, seller carrybacks, and of course, local 1031 exchanges. And so I really understood that part of tax mitigation for the client and how to basically put a deal together and structure it the way that they would be interested in moving forward.
Got it. That sounds exceptionally creative. You really pulled all the strings.
Yeah, we did, and we had a lot of just the knowledge of trying to figure out how to do that. I'm just a knowledge junkie. I just love to learn, and every time I find out somebody did something more creative than me, I want to learn how they did it and kind of keep going forward with that. So that led me what I'm doing now. Basically, about 4 or 5 years ago, I started hearing about DSTs. And
what is a DST?
Delaware Statutory Trust.
Okay.
And I'll get into that in a second. It's a terrible name, but it's a great solution. But to wrap up my background, basically, I hooked up with a good friend of mine who became the founder of a company that I work for now, and they are a broker of DSTs, which is a novel role that I had to this day. I don't see it very often. So to step back a little bit, what is a 1031 exchange? I'm sure a lot of the listeners, have some understanding of what a 1031 exchange is, some more than others. The DST is a further niche of that. But to go back a little bit to 1031s again, it allows you, it's IRS Section 1031, Internal Revenue Code. Oh, everyone loves the Internal Revenue Code. It allows for people to trade investment properties without having to pay the taxes. Now, it doesn't mean you don't have to pay them at all. They get deferred into the next property, but allows you to sell an investment property and buy another investment property without having to pay the taxes at that time. Now, what kind of taxes are we talking about? We're talking about, obviously, federal capital gains, 20%. State taxes, depending on what state you're in, that's 0 to 13.8%. Of course, we're lucky to have the 13.8% here in California.
Don't want to miss a thing.
Yeah, of
full
course.
California experience.
Good old California. There's a newer one in the last 10 years. It's called the Medicaid tax, and that one is a 3.8% tax. And then the one that people really forget about is depreciation recapture tax.
Oh, everybody forgets about that. Yep.
Everyone forgets about it.
It's brutal.
25% of what you depreciated. And if you have a good accountant and you have an investment property, you're probably depreciating it every single year.
Definitely.
You are 25% of what you depreciate, you'll owe back if you don't do a 1031. So that stuff really starts to add up, and you start talking about numbers of 30 to 40% of your sale proceeds going to the government. Let's just put that into a number real quick. If you have $1 million proceeds out of a sale and you have to give away about 400,000 to the government, now you have 600,000. That's something
right.
You're not going to feel like that millionaire anymore, and it's going to be a big hit for sure. So what a lot of people do is they do the old do nothing, say, well, I might as well just keep what I have, even though I'm kind of sick of managing the property, or I'm having issues, or I just kind of want to go into passive investing. So obviously the biggest advantage to a 1031 is tax deferral, along with some others, but that's the major one. So the important thing to know is that 1031s are just the equation. It's just the equation of how to do that structure. The reality is it doesn't finish or fit. What you have to do in that scenario is you have to have replacement property. You have the property you can sell. You can do a 1031 to actually mitigate those taxes, but you still have to buy that next property.
And you need someone to facilitate it as well.
You do need an exchange combinator. They're like an escrow. They hold on to that money while you're in your 1031, and so they hold on to that in trust. But you still have to find that next investment property. And where most people who are familiar with 1031s, they believe they have to buy another piece of real estate direct. So if you sold an apartment building, you probably have to go out and find another apartment building, or an industrial property, or a triple net property.
So it sounds like you can do some horse trading here.
Well, a lot of it's horse trading for sure. That's how it used to be in the old days before they did deferred exchanges, was just one for one. But what people don't know is that they can actually invest in a structure called a DST, Delaware Statutory Trust. And that is a fantastic structure. It is allowed by the IRS. It was allowed in the IRS in 2004. And
so it's pretty new then, really.
It's very new. It's very new. It's been really ramping up in the last 5 to 7 years. It's a market that's been pretty much doubling since then. And so it grows, and for good reason. It's basically, for a lot of my clients, demographically, they want to go from active to passive management. They want to go from, depending on what age they are, they're just looking for something that's going to be a little easier for them. They're kind of over the management, the 3 T's, tenants, toilets, and trash.
Right.
And there's a number of obvious other asset classes where they want to trade into it, but those are the main ones where they want to say, you know what, there's got to be a better way, and I don't want to be consistently thinking about my real estate. And so this is a great option where they can get into institutional quality real estate all over the country with professional sponsors. These are real estate companies that have been around for decades, and they're typically worth billions of dollars. So they know what they're doing when it comes to real estate.
Okay, this is the big time.
Very big time.
All right.
And you're at a level that's much, much better in terms of, what kind of real estate are we talking about? If you have $1 million to go out there and buy real estate, it's surprisingly, it's not a lot in terms
it's very small.
It's very small to go out and find another piece of real estate and have to try to, build some value on it. Whereas some of the deals that we have on the DST side are going to be, let's say a 2020 built 400 unit property in Austin, Texas, multifamily. There could be class A plus class B. There could be senior living facility in Delray Beach, Florida. It could be a portfolio of self-storage facilities. It could be
Hmm.
an industrial property with Amazon as one of its tenants. Could be a basket of triple net properties all over the country. And we're talking about big ones: CVS,
Hmm.
Walgreens, Walmart.
Okay, I
Those
see.
those deals are $20 million deals minimum. So
Hmm.
even at $1 million, you try and go out there and find a triple net, you're not buying a CVS. So
Yeah.
you get
Okay.
quality stuff out there, and you get it in a fractional percentage. So what's great about that is it allows you to put as little or as much as you want to in the deal. And so what happens is, that client comes to me with $1 million exchange. I'm going to help them put a fraction of that into each deal. So maybe 200 into the
Mhm.
industrial
So they're
deal.
going to spread out their risk.
Totally. You mitigate a lot of
Yeah.
risk in different locations and all that. And you get to go ahead and put a little bit into each deal, and you kind of create a nice little custom portfolio. And what's great about that is that obviously you fill your equity percentage, but you can also fill out your debt percentage. So you actually have to replace that debt too. That one people forget
Mm,
too. So putting that whole package together is something that's really what I pride myself in, and doing that for each client, and something that I really enjoy. And that's what I do for my service.
that's absolutely fascinating. I,
Yeah,
uh, I didn't realize quite how much went into the DST side of it, especially the debt capture component. So that's
yep,
fascinating. Right on.
yeah. There's a lot of ins and outs, and so we're happy to help.
Okay, very cool. Well, it's just about time for us to take a commercial break. So thanks for getting us started. That was fascinating. And folks listening out there, we'll be back here in about 2 minutes after these messages. Thanks for listening to The Real Men of Real Estate right here on KCAA Radio.